Market structure. What is it and why is it important? In this video, we're going to talk about market structure, what is it and how you can apply that in your strategy. We are also going to see some strategies using market structures that they really work if you follow the rules of them step by step with a strict discipline. Hello guys, my name is David and in this channel we talk about trading different assets such as Forex, crypto or stock. If it is something that interests you, make sure to subscribe to the channel. Okay, before we talk about the concept of this video, let me touch on something fast for those of you who have been following this channel and watch the short videos. I started making short videos in this channel and we are supposed to make longer version of the videos. However, I got busy with some other businesses, plus I had to trade, so I didn't have much time. I didn't have extra time to spend on making videos, unfortunately, and that's why I haven't made some videos for quite some time. But every now and then I got some emails, some comments that ask me to make the longer version of those videos because actually I promised to do so. That's why now that I have a little more free time and those businesses are settled to some extent, I decided to make the longer version of videos and of course some other videos and share my experience so you don't have to experience them yourself. Anyway, if any of my old subscribers still follow this channel, I appreciate it and I hope I can make some useful videos for you. Okay, without further ado, let's start the video. Market structure is one of the most important concepts in trading, specifically if you follow price action strategies. In any strategy, the first thing that you have to spot is the condition of the market, whether the market is going up or going down, or for example moving sideways. You have to detect that with whatever tool that you have. Something that you've probably heard, which is a popular phrase in the trading world, is that trend is your friend. In other words, you should trade in the direction of the market if you want to have a good win rate. Of course, there are lots of counter trend strategies, but even for those strategies, you have to first spot the trend. And knowing the structure of the market is one of the efficient ways that you can spot a trend in particular and the condition of the markets in general. Okay, now you might say, what is exactly a market structure and how we can figure out if we are in an uptrend or a downtrend or in a ranging phase. Basically, as we mentioned, we have three phases: an uptrend, a downtrend, and ranging or consolidation phase. An uptrend is where the market or the price is making higher highs and higher lows. You see a move goes up and then correct itself and then goes up again and breaks the last high. As long as the market repeats this structure, we are in an uptrend. On the other hand, when the market makes lower lows and lower highs, we are in a downtrend. The price goes down and then corrects itself and then moves back and breaks the last low. As far as we have this pattern, we are in a downtrend. Now you might ask, what is a consolidation or ranging phase? Basically, every move that is not in those two categories, I mean uptrend or downtrend, is a ranging phase. Either the price can't break any highs or lows, or the price might break a high or low, but it can't repeat itself and make another high or another low. This is the whole concept of market structure, as simple as this. Now you might ask, if it is that simple, why many people can't use it and make profit out of it? Well, first of all, the market doesn't always move nicely like that. Sometimes we have volatility, choppy markets, and some moves with different sizes that makes it difficult to spot clear highs and lows. Secondly, making profit out of market with any strategy needs experience. You have to be experienced at that strategy. You have to look at the moves for quite some time in different assets to get a good grasp of any strategy. Not every novice trader can make profit out of this strategy or any other strategy in general. You need practice. And third, you have to follow a strict money management strategy. Becoming a trader is not just having a good strategy. You have to be disciplined. You have to follow a comprehensive money management strategy. You need to know where and when to enter the market and exit the market, and follow those rules in every trade that you open. A strategy might be profitable for a trader, but not as profitable for you, or even you might lose money on that strategy. So experience, following a money management strategy, and having discipline are the three pillars that make you a profitable trader. Okay, now let's see one of the strategies using market structure that are really profitable if you execute it well. There are lots of strategies that you can apply, but this specific one is one of the most profitable ones. The first thing that we have to do after opening our chart is to figure out the condition of the market. Step 1 is to zoom out your chart to see the whole picture. Step 2 is to see whether we are in a trending phase or consolidation. Our strategy here is based on trend, so if we can't spot a clear trend, we should close our chart and open another asset's chart. We do this until we can spot an obvious trend with clear highs and lows. One important thing here is that the size of the consolidation in our trend must be somehow similar to each other. There is no need to be picky here and count the candles. Just a close ratio will do the trick. We do that because we don't want to be trapped in a lower time frame move, because sometimes there are smaller moves related to lower time frames inside a larger or higher time frame move. Breaking those smaller moves might not indicate a reversal in larger moves. All in all, we have to wait to see a mature consolidation, as large as the previous ones. The next step is to wait for the break of the mature consolidation, which is the last lower high in a downtrend or last higher low in an uptrend. Here we can enter the market right after the break, but a better option is to wait for a reversal confirmation. The reversal confirmation can be either a candle with a long shadow, preferably longer than its adjacent candle shadows, or some candles rejected by the broken support or resistance area. The last step is to set up our limitations, which are our take profit and stop loss. Since we are trying to catch the beginning of a trend, we can have a very good risk to reward ratio, which means our take profits should be longer than our stop losses. We set our stop loss before the trigger candle or candles. Our first TP is double the stop loss, and the second TP is a trailing stop. It means we let it ride the move until we get a reversal signal. This is the first strategy that I used profitably after 1 year of the beginning of my career way back. There are some other variations of this strategy that you can use after you get used to the strategy and know the different forms of the market, how the waves are formed in different assets, and after getting experience in using market structure in general. Of course, we are going to talk about more in other videos and talk about other variations as well. But for now, if you want to use this strategy, make sure to execute them well as we planned in the video. I hope you find this video useful. If there is any specific strategy that you want to know about more, please let me know in the comment section so I can make a video about it. Plus, if you find this video useful, give it a thumbs up and subscribe to this channel if you haven't already. Thank you for watching and see you in the next video.